On another level of that is the fact that they're trying to also make it harder for people to become non-residents, so they're bringing in a concept of a decent residency, where if you've been a long-term Australian and you want to go overseas, they don't like it for you to just say, click, I'm now a non-resident from the day of departure. They don't feel comfortable with that. They feel you've had too much benefit and it should be a progressive thing. Now, they've done it in two splits. They've done it here as what they call the overseas employment rule, where if there is a specific expat situation where you get a job overseas and you leave, if you have been living in Australia for the 3 prior years as a resident, then to become a non-resident, you must have at least a 2-year employment contract that cannot be from a family-related organisation. You must have genuine accommodation to stay in that place of occupation. But most importantly, and to me, most difficultly, you have to spend less than 45 days in Australia each year that you're working abroad. If you do more than 45 days, you would lose this benefit as a non-resident and you would be potentially taxed on your entire income overseas. Now, that's a massive problem, and hence these 45 days sounds long, but it's quite soft in my mind, especially if you're in an original role, especially in a post-COVID, hard to travel environment, especially in a world where you might want to go back, for family or whatever the case may be. I'm very concerned about the 45 days. If you're not going overseas under the employment rule, if you're just deciding to just go and relax and just move overseas as a retiree, for example, then it gets even a little bit tougher, because you will not be considered a resident until you have been in Australia for less than 45 days for at least 2 of the previous income years. So the fact that you move overseas, if you did not do that as a result of getting a job, then you are not going to be automatically entitled to getting non-residency status the day you leave. It's going to be carried forward until you've been away for up to 2 years. Now, they generously will give you a foreign tax credit if you're paying tax or earning money in that foreign country, but that can be an issue for you. So you've got to look at that. It's going to be more complicated, not less complicated than the current rules. But again, this is probably aimed at people that travel. If you go overseas for an extended 1-2 year long-term holiday, that's going to be the fact that your residency won't change. But the strange thing is, under the current rules, that would still be the case. You'd have to show that you live somewhere overseas, in order to break your residency. If you're just traveling, that doesn't change residency under the current regime. Now, if there's a double tax agreement, which Australia has with many countries, but not everyone, then that would override these residency rules. So if you were deemed to be a resident of both places, the double tax agreements work in essence to allow the country where you earned the money to be the one that is allowed to tax you, and you would be excluded from the other. But what happens, and what they propose to change, is currently, if you're in a double tax agreement situation, you're deemed to be a resident of both places. And what that would do is that would still continue to afford the 50% capital gains tax discount, for example. And what they want to do is change that to say that if you are entering or benefiting from a double tax agreement, then they want to flick you to be a magical non-resident and lose things like that 50% capital gains tax concession. Again, probably unfair, hard to argue though. They're probably going to get this one through, but I think that's probably against, again, all of our many years of proof and law, but we'll see what happens. The other example they use is what they call a short-term resident, where someone who has been overseas came back to Australia or migrated to Australia. So if you've been resident for less than 3 of the prior years, so you've been there 1 or 2 years, then you don't have to worry about staying a resident if you leave. As long as you spend less than 45 days in Australia, your residency would cease on departure. So that's going to help some expats, that's going to help some migrants that come if they decide to go back overseas. But again, that's not a very high proportion of the general population. So this to me is still an issue. And again, it comes back to this 45-day test whatsoever. So 45 is going to be the most important number in the expat world for the next 2 or 3 years. Now, again, any government employees that are deployed overseas, they will remain resident, as I previously mentioned. That's not going to change. Nothing really there to worry about. And that's always been standard and sensible. They are making it a little bit better to confirm and clarify that if you just work for an Australian embassy because you happen to be in the country, i.e. they did not send you there, they're confirming and clarifying that you're not on Australian soil and not taxable for that income. You're taxed on local tax. But apart from that, everything is pretty much it. But you can see how critical these 45 days are. And that's really what we've got to focus on.